How capital allocation impacts volatility. We looked at strangles before on a study like this, and today we are going to look at puts. Now, the reason for this is we are making the final case. This will be our last study on this topic, but we are making the final case for how do you what's the best way to essentially limit your risk, reduce your volatility, allocate capital when you're selling naked puts or when you're selling strangles or whatever else it is. And we've came up with the conclusion that everything's best if you manage a 21 DTE. Strangles, straddles, puts, everything. The earlier the better, but not too early because then you leave a lot of money on the table. We've demonstrated how capital changes can influence the portfolio volatility of one standard deviation strangles. This is from our last, we did this last week. Overall, exiting at 21 DTE offers the best volatility control. Now, again, what most people worry about is not how much money you can make, but it's how much risk am I taking? In order to control risk, you have to control volatility. So if you want to focus on volatility control, exit at 21 DTE or do something at 21 DTE. Adjust the position, do whatever you have to do. And you can see here, you make the most money, you have the most volatility control if you do something at 21 DTE. That's with strangles. Does the same thing apply to puts? Now we'll take a look at another popular strategy, selling naked puts. Do we expect to see a similar result? Well, of course. I mean, why would we think we're going to see something different? But the question is, how much similarity is there? So in this case, we looked at selling the 20 delta puts because that's what we usually do at 45 days to expiration. And we either held to expiration, managed to 50% of max profit, or exited at 21 DTE. Just like I said, of course, we expect to see a similar result where exiting or adjusting at 21 DTE is going to be, when we say exit, that's a roll is like an exit and it's a reestablishment.
Right.
Exiting at 21 days to expiration maintained a similar level of volatility between strangles and puts, while the other approaches saw an increase in volatility. So you can see here that when we exited at 21 DT, whether it's a strangle or a put, we basically had the same percentage, 0.6. Whereas with just going to expiration or just managing at 50% of max profit, you actually saw an increase in portfolio volatility. The answer here is that, yeah, 21 DT worked.
Which you would expect. Nothing surprising there, right?
Yeah, nothing surprising. So we take that 20 delta put and we say, thanks to a decade-long bull market, which is fair, managing winners in puts boosted returns and outperformed other strategies in terms of profits, of course, because we've basically been going up nonstop. Meanwhile, exiting at 21 DT proved to be the most effective in controlling volatility. You can see here that we take the least amount of vol risk and basically make the same amount of money. I mean, it's pretty, when you graph it out like this, it's pretty black and white.
Yeah, hard to.
So now we're going to examine how the capital allocation process impacts portfolio volatility. Within the same portfolio, we're going to increase the capital we commit to the strategy from 25% to 35%. So we're increasing by a significant percentage the amount of capital we're allocating to the same strategy. In this case, exiting at 21 days also provided the best results for maintaining volatility in a tight range. In contrast, holding positions to expiration and managing at 50% resulted in even higher volatility increases than compared to when using strangles. So what happens here is that if you manage early, you eliminate all that additional risk from whether you're hoping for 50% or you're hoping to hold all the way to the end. It doesn't make any sense. So when people ask us, it's just like, hey, we manage our positions.
And why do you manage your positions? Here's a good reason.
So with more capital committed to the strategy, we observed a large increase in profitability and volatility by managing winners. Everybody made more money. By managing early, we had less volatility while making more money. And that's all.
Less volatility in the portfolio's P&L, right?
Yeah, exactly.
Got it.
In both the strangles and the put tests, exiting at 21 DTE stands out as the best approach to controlling volatility. Regardless of capital allocation levels, exiting at 21 DT remains the most effective way to control volatility while managing winners provides stronger returns in bull markets. Yeah, I mean, obviously, if we knew it was a bull market, all we would ever do is sell puts. The whole key here is, because we don't know what the next cycle is going to bring, just manage early.
If you tell me the future, I'll show you how to profit.
That's right.
Sure.